I will say our equity portfolio will be as high as 75%. Maybe 60-61% should be large cap. Okay, 14-15% will be mid, and roughly 25% will be small cap. India is buy on dip. Structurally, something has changed. The tariff noise or the global noise which is playing out now, I think India is a beneficiary of it. Let's say it's a traditional mutual fund industry. Everybody talks about long term. Why long term? Because managing long term risk is easy. Your mistakes are also hidden. So time in the market, I'm not debating, but timing is important. I always say with good amount of confidence that timing is everything and everything else is conjecture. If you pull out 5 years data, then you realize small cap will outperform large and mid also, okay, and large decisively. So if you have relatively higher risk appetite and in longer term investment horizon, then I think I will still recommend small cap.
Welcome to the latest episode of Guru Portfolios, where we quiz fund managers, ace investors, and leaders from the world of finance. In today's episode, we have with us Sandeep Tandon, who is the founder and chief investment officer of Quant Mutual Fund, which manages assets close to rupees 90,000 crore with a unique investment approach which is backed by data. Hi Sandeep, welcome to this episode of Guru Portfolios. It's great to have you here. So Sandeep, let's talk a bit about your background, how you came into markets, your beginnings in the early 90s in a phase of market mania, and your entry in Badla market, and then also your early entry in derivatives markets. Can you talk a bit about that and how that shaped your, investment thinking to an extent in your early phase?
So actually my journey started in peak of the market, we call mania fake of Harshad. I came in the market in 1992, okay. And it was pretty early stages. So I was very interested, to understand that hype which got created, and that was the genesis for my behavior thesis, okay. And we have good news is that we are able to decode that maniac phase versus the euphoric phase or any other thing. Till date, I can say with good amount of confidence, we have not seen the repetition of maniac phase. Okay, we have only reached a euphoric phase. We have never hit the maniac phase what we have seen in 1992. So which whenever it happens, it means that would be a long-term top of the market. Okay, that's the first way of looking at it. Second thing, I was a very early in Badla market also. So I've seen Badla market was also very interesting. Is that is all about the how you read through numbers, the behavior characteristics.
Benefit of our listeners like a forward market.
Yes. Okay. And if you know that BSE is the oldest exchange in Asia, so we have a traditional derivatives market, it's like a local derivative market, Badla, Chotka, Fatka, all those terminology. A lot of people, this terminology is very new. But it's a very interesting market how we have developed the old fraternity has built that thing, and you can reverse calculate and calculate the mood of the market. Okay, the Badla rate was giving you the mood of the market. See how sentimentally you can decode that. In those days, there was no Twitter or social media that you can gauge up to certain extent where the bullish or bearishness is getting built. But this rate was mathematically was it. That's the reason I always talk about market implied analytics. The genesis of market implied analytics actually comes from this market, because you can reverse calculate, okay, and try to gauge. And that has been a very important learning for us. So it's those days was very interesting actually, and world has changed. The good news is that we have evolved those numbers and have converted, and we have changed over a period of time. That has helped us. So the mindset of being on a very early stage analytics and behavior thought process has helped us.
Right. And your early entry into derivatives also has further, I believe.
Correct. The derivative also was I was very early,
Right.
So
that also helped shape.
Yes, because it was easy for me, because my understanding on the Badla market was there, and that's the reason I was very early into that space, and that really helped us.
So Sandeep, now let's get into your personal investments.
Yeah.
What's your current asset allocation mix like, and how has it changed over the past year? And then maybe you can give us more 5-year perspective. But first, we can talk about this year and last year.
So I'm saying that in last 5 years, if I have to talk about, we have seen a massive bull run in equities. So our equity portfolio actually increased significantly. If I have say the 5 years back could be 50-55% sort of the equity, maybe 50%. Today is actually 75%. A, we have deployed fresh money also, okay, and B, the appreciation has come. So today our portfolio, maybe I will say our equity portfolio will be as high as 75%.
आपका
Correct, personal. I'm talking about personal. And then maybe a 15-18% should be the real estate which we have, the family owned residential and commercial places, predominantly residential.
Right.
And remaining amount is the liquid fund.
Okay.
I don't take duration calls.
Right.
So predominantly liquid fund.
So 5 years, you're saying the major thing is that equity portion has gone up significantly. And what was the equity portion last year around?
Something similar, 72-73% type sort of thing.
Oh,
something
more
similar.
or less.
Similar.
Give or say few
Yeah.
percentage.
Last 1 year, we have actually deployed more money to the
Okay.
market.
Okay, got
Okay, that's the reason.
Got it.
Because market has not gone anywhere,
Yeah, yeah.
either marginal positive or marginal negative in last 1 year perspective.
We'll come to that how market has been consolidating and what's your outlook there. And can you also give some flavor about, within your equity allocation, how is the market cap split? There also, I believe some rebalancing have. Yeah.
See, as you understand that I invest 100% of my money in my own mutual fund scheme. So all this money is in quant mutual fund scheme. So as a money manager, we took a very conscious call in July 2024 and we said there's an early risk off period. So in a risk off period, what you do, move from small and mid to large, okay, and move towards from low beta, high beta to low beta. That as a fund house we have done. Since my money is 100% there, by default, my portfolio also got reallocated. So today, if I can say maybe 60-61% should be large cap, okay, 14-15% will be mid, and roughly 25% will be small cap.
Okay, of the equity portion.
Yeah.
Right.
So actually, small cap exposure has moved up.
Okay.
Mid has come down.
Okay. Got
And large has moved up.
Got it. And also, like, how often you rebalance your personal portfolio?
I don't have to do it personally because it's a part of the mutual fund scheme. So when they rebalance by default, my portfolio also gets rebalanced.
No, that's true. And in terms of returns, roughly what kind of returns have been over the past year and 5-year CAGR, if you can share?
So if I look at, see, last year returns has been few percentage minus or few percent positive depending on which schemes we are talking about, okay? So it's a more of a consolidation phase for us as a house also. But in last 5 years, his returns, if you look on the CAGR report, maybe small cap could be around 49%. I think flexi will be 36%, okay? So it has all our schemes, if you look at in last 5 years, actually has beaten down the indices decisively. And, either we are number one or we are number two in 5 years category. Most of the schemes are actually rank one in terms of absolute return and relative returns also. When I say relative, from the market, from the risk adjusted returns.
So on an average, if just 1 year agar dekhe to marginal minus
Minor plus or minor than. So it's maybe few percentages highest only.
Okay.
Overall
On the
portfolio.
scheme.
Because we have a large exposure in small also.
Oh, right.
So
Depends on which.
yeah.
And a lot of investing is about investment behavior. So, for the benefit of our viewers, how do you personally react, when you have had 34 years of experience in markets? So how do you react when you see a negative return?
See, I tell you what is very important, that this market is all about cycles. Okay, I always describe this as a cycle, Nobody has identified the exact rough or crest of the market, okay? Now, if I have to look at, let's say, much larger, longer term cycles, if I were to talk about, an equity market is about long term. See, I always say that stocks and sector can be looked from short term perspective, but if I have to talk about investor and equity and asset class is a long term. So let's say 5-10 years perspective I look at. So if I have let's say from here 5 years, forget 10 years. If I have to talk about next 5 years, we think we are very constructive on an equity. And we have been saying that something has changed for India, because with the help of perception analytics, we have said that India perception has changed, which means the P multiple or any valuation multiple which you look at will remain elevated for longer period of time. Okay. Now, this is the phenomena which people have seen right from 2022-23. People are questioning market has been expensive, but market actually rallied. Okay, they rallied till as late as September, October 2024. Okay, so for nearly 2 years, when people thought, or majority of the investor thought it is expensive, market continues to rally. So we have to live with the reality. India is buy on dip. Structurally, something has changed. So if I believe in India long-term story, and given the tariff noise or the global noise which is playing out now, I think India is a beneficiary of it. In absolute terms also, and in relative terms, we have extraordinary benefit. So with that background, if I have constructive for India from next 5 year perspective, that 1 year doesn't matter. But again, I always say that in last 5 years, as a fund house, we have generated extraordinary alpha. So I always say in risk on period, generate extraordinary alpha, and risk off period just lie low. Okay, because you already have extra alpha. Now it is not fair to say that every quarter, every month, every year, I have to be in the top of the chart. Every year I have to, then it is a risky strategy. So the risk is all about you have to be early. You have to ahead of the curve in 95. If event has played out and then you say, I'm going to rebalance my portfolio, then you might be late. We as a house, we always say we are in the business of risk management. Returns are byproduct. So moment we see risk unfolding, even from a known risk, unknown risk, nobody can foresee. Even from the perceived risk, when we see the perceived risk which is building up, we do take cautious approach. Okay, so this business is all about that. I always say a lot of people chase returns. At the peak of the cycle, every investor has a large risk appetite, and every investor is long term. But in 6 months, when cycle changes, people realize they didn't have that risk appetite. Okay, they are actually not long term investors. Very important to identify. I always talk about, you go back and see how you have reacted in 2000, what you did in 2008, what you did in 2018, or what you did in 2020 when COVID happened. It is your behavior which you can understand better than any wealth manager or any advisor. If you can analyze that, then you can able to place your bets accordingly.
And Sandeep, you have often, spoken about your investment style, and tell us more about your data-driven approach, and also, your ideas. Although the way it is perceived outside is slightly unconventional. You talk about short-term, long-term, medium-term, and even decadal in one breath,
Yeah.
right? Then you also talk about importance of timing, whereas everyone talks about quote unquote time in markets. So, थोड़ा उस बारे में आप
So let's understand investment needs first. Okay, because people have both short term, longer term needs also. So you can't tell your wife, okay, let me save first, and after 10 months we will go for holiday. Okay, or we'll save for few months, then we go for restaurants. Okay, so nobody will appreciate that. So if human needs have short term, medium term, and longer term objectives, hence I also believe that your investment thesis should also incorporate that. And this is more from a risk perspective I talk about. Let's say it's a traditional mutual fund industry, everybody talks about long term. Okay, why long term? Because managing long term risk is easy. Your mistakes are also hidden. So everybody talks about 10-year. If your 2-3 year cycle also goes against you, then you average it out, you looks okay with that part. That's the one thing. But when I look at the risk perspective is that if for whatever reason, let's say a situation like Japan come, so after 97, market has not made a new high till 2024. So that is the phase. Maybe for nearly 30 years, nothing happened actually in the market. And if you have invested for everything from long-term perspective, then you will not able to generate absolute return. You might be closer to the index, but ultimately aim of the investor is to generate alpha. If 30 years you can't generate any returns, nobody likes it. And hence we always say certain portion of your portfolio should be long term, medium term, decadal view also we take short term, near term. So it's a combination. So when we construct our portfolio, our whole idea is that diversification from risk, high risk, medium risk, low risk portfolio, and duration diversification also. So I can have a longer duration, medium duration, and short duration portfolio. That actually fulfills the entire need of an investor. So let's say a cycle is against you, and in short term, let's say market is able to generate alpha. So if you have 30% short term, at least your 30% portfolio will generate versus 100% having a long term. So it's a very, I call it pragmatic way of managing money.
And sir, what's your data-driven approach? Like, how do you, of course, a lot of people know a bit about it because you have disclosed it in many times in your fact sheets on your website. But can you, like, for an investor, slightly break it down, how you look at different data points, how you understand liquidity, risks, and, also timing, etc.
So let's understand. See, we all understand the importance of data. Okay, we always say markets are so dynamic, data points are changing regularly. You get up in the morning, in today's context, you see Trump's tweet, you learn what is happening with the global asset classes, and then our opening is dependent up to large extent on that. Okay, so you cannot ignore it. So when you know that you are living in a dynamic world, how come your investment style remains static? You can't live with this season, doesn't matter in short term. Let Trump say whatever it is. I'm a long-term investor. Long-term, my valuations game will play out, earnings will play out. I'm not debating that part, but that is one factor. But if you ignore this data point, then you will not able to generate desired return. And I'm also talking about you might be landing up in taking more risk. Okay, so when you're trying to generate and the entire thesis when we bring about dynamic style of money, when it's all about adding alpha and subtracting beta. So basically, we are trying to say I'm trying to generate superior risk adjusted return. It is unfortunate that most of the investors look only at the absolute returns or maximum relative returns. Okay, very limited people look into the risk adjusted returns. So it's very important to understand the risk adjusted returns thesis, and hence the entire thesis revolves around data analytics. Okay, so it really helps. See, today's world, a lot of people have their own philosophical approach. Somebody say I'm a value investor, I'm a deep value investor, I'm a growth, or I'm a techie, or growth at any price, depending on the mindset of individual. We try to say that objectivity is our religion and data is God. The whole idea in our investment thesis is remove the subjectivity of money manager. Okay, because we all have preconceived notion. We have grown with lot of our own perspective. The environment, so biases will come into picture. So this is the when you talk about data analytics, I'm removing the subjectivity. I'm bringing objectivity in my day. How you bring objective is through analytics.
Right. And you have also a particular framework called VLRT framework. How does that work? It quantifies sentiments, it quantifies liquidity
Yes.
and time.
Yes.
Timing also.
See this, I have actually, I said that the whole industry, including myself, we have only grown with one thesis that earnings drive everything. Okay, which is largely the valuation, and everybody says long-term earning will catch up. I have learned in what experience that earnings are important, but valuation multiples are equally important. When earning expands and valuation multiple expands, you make more money. And sometimes your let's say earning keeps on expanding and you have peaked out in terms of multiple and multiple start contracting, you land up in actually losing your capital. So it's very important to understand. That's the reason this whole thesis of VLRT came, where we give only 1/3 weightage to the valuation analytics, 1/3 on the liquidity, because liquidity is also a lifeline. Okay, if every times you talk about in last few months more money has been shifted to US, money shifted to China. Okay, so we understand the importance of shift. But why don't we capture as analytics? We capture. And third most important is about sentiment. See, it's a psychological number. Okay, if you are mentally comfortable, then you have better thinking, rational thinking is there. Once you're in a chaotic mode, okay, so you will mess up everything. That's the reason we say we capture the sentiments, and sentiment is also important player in the market, and that's the way. So 1/3 valuation analytics, 1/3 liquidity analytics, and 1/3 is risk appetite, which is sentiments, and T is the timing analytics, which is a combination of all three analytics put together. So timing is also a vital tool, because as a student of management, what we have been taught, right place, right time. This is what we think. Any business, if you're late, you are late, correct? Now, when it comes to market, we always often say that nobody has time the nobody should time the market. Time in the market. Time in the market is, I think, is a good concept, but time in the market reflects your experience. Okay, more maturity you bring. You have seen multiple cycle. By you will become a mature investor. So time in the market, I'm not debating, but timing is important. I always say with good amount of confidence that timing is everything, and everything else is conjecture. And it's a risk mitigation tool.
Right. If you get it right, you can also minimize.
And we always say that we also don't get it 100% right, but at least we put in efforts
Right.
through mathematical models to code these timing aspects.
Right.
Okay, so we always say that 28% time we don't get it right. It's only 72% time we get it right.
But potentially that 72% can cover up.
Yes.
Got it. And quant small cap fund, which is also obviously you are also invested there, because you 100% are invested in your own mutual funds. It's one of your largest funds. So since you have seen that space so closely, and I know you are also not someone. You are very dynamic in the sense you will move to large cap and you see risks. Going ahead, what's your view on small caps? Do you still think that there is a defensive play that need to be slightly guarded, as you have been a bit in your small cap portfolio?
So again, that depending on the investment horizon, I think it is not fair to say that market a small cap one should avoid. They have peaked out and nothing. I think I always link small cap with the risk appetite of individual investor, risk appetite for the market also, and what is more important for risk appetite for individual investor. Let's say in any cycle, if you look at from longer term perspective, like 30, 40, 50 years data you pull out, and if you look at, let's say, forget 1 year, 2 years, I'm saying let's say 5 year or not even 10 years. If you pull out 5 years data, then you realize small cap will outperform large and mid also, okay, and large decisively. So India is a growing economy, okay. When you're talking about manufacturing base is a new driver. So far we have seen the services, now the manufacturing is a new mantra which is coming, which means India from a long-term perspective is constructive, and where you generate maximum alpha with small cap. So small cap, what is important to understand the investment horizon. If you have 5 year investment horizon, a relatively high risk appetite, I'm using the word relatively, okay, because you need to have a risk appetite to come into the equity market. Otherwise, you should be happy with your bullion investment. Even that is also not. That's it. Then is only the liquid assets. If you don't want to take a duration risk also, any asset class you come, there will be a risk. Okay, the business is all about you have to evaluate those risks, and unless you don't take any risk, you will not generate any return. So if you have relatively higher risk appetite and in longer term investment horizon, then I think I will still recommend small cap. Okay, now if you look at our model portfolio also, or most of the scheme, yes, we pruned down small and mid from July last year itself. But in last 3 months, we are talking about minor risk on environment. Last month call also we say risk on environment. We have actually increased our small cap exposure and we have cut down our mid cap exposure. Okay. We have increased large cap and we have increased small cap.
Which is what reflects in your portfolio also.
Yes. So I'm very constructive on this space. If you are only, if you are very, you can't say that I am positive on India, very constructive on manufacturing, long term picture is good, but I will not buy small cap. Then I think you're not doing justice with your investor or your investments. Okay. And hence you should have a good balance of small cap also in your portfolio, provided you have that 5-10 year horizon. Let's say in this case, minimum 5 year horizon.
Got it. And how would you navigate this tariff-led uncertainty that's come in sector-wise? Where do you see opportunities? And right now, would you say that the market is in a phase where, for a data-driven fund manager like yourself, there is not much in terms of decisive data points?
So I will say in last 3 months, as picture become more and more clearer from Trump side also, we have enough data points to talk about. Our challenge only comes in the market when market volumes disappears. Okay, when the impact cost moves up significantly, and we have seen because of various regulatory changes in happen in last year, we were early to highlight that impact cost will rise. When you have a very large impact cost, we have challenges. Okay, because any times of sector rotation, stock rotation becomes very difficult. Okay, entry exit becomes difficult, and that's not a good sign of the capital market, because we need very healthy capital market. When I say healthy, both the depth and the breadth of the capital market should keep on expanding. That's the way it really helps the bringing institution investors. Okay, otherwise it becomes a very shallow market. Now if I have to talk about where we stand in terms of this thing, I think we are in a very unique situation. Both America and China are fighting for their supremacy. It's not battle about tariff. Tariff is the excuse. The real battle is supremacy, where US understand that China is the real one country who can give threat to US is China. Russia has gone, Europe is not able to deliver, and India will take some more time. Okay. So in current context, this battle is all about. And if the battle deteriorate, let's say, I think India is a beneficiary of this battle, okay, where we are playing very mature game. In fact, I'll appreciate Mr. Modi went all the way to US. A lot of people said that is a signs of weakness. No, it's a perfect strategy, okay. You can't ignore the largest economy. And if you can, with the help of bilateral talks, can settle this tariff-related challenge, I think India is a winner. Okay, so if every country wants to move away from China for strategic reason, I think if country like India will be beneficiary because of sheer scale. So you can talk about Vietnam and Bangladesh, okay, or Philippines up to certain extent, or up to certain extent Indonesia. Yes, they are competing in some of the areas with us, but they don't have that scale what we have. So if it is not fair to say, look at Apple, what happened, okay, they are playing the scale game, no? Now they can say I can switch from China to India, but they can't say that I can switch from China to Vietnam. So it's a scalability game of the population what we have, or the demographic is in our cycle is in our favor. So I think it's a great opportunity. We are in that unique inflection points. On a relative basis, India should do very well. So I remain very constructive on the markets from a medium to longer term perspective, irrespective of short term characteristic which can change depending on the noise levels or narrative getting built.
And coming back to your own investment journey, has there been any learnings that you can share with our viewers? Because that can help them in their journey, as you have like now hindsight benefit of 34 years of experience.
The only thing as a Indian we have seen the two mistakes which we have made. Okay, one is that in about asset allocation, because we were never taught asset allocation. Even my father, being a guy from financial market, didn't talk about financial. Okay, we being from coming from north, we were skewed towards real estate. Okay, in come to south, they are skewed towards gold. Okay, so I think India, as most of the people are more skewed towards real estate and gold, they have not really allocated right allocation to the equity markets, debt market in the form, not to the debt instrument in the form of FDs and some other instrument they have capitalized. I think what is missing out is the balance approach. Okay, when you are young and you're starting your career, the first thing is there, I should own a house. The starting point is owning a house. So you will, whatever saving you are having, you will take loan and then you try to repay those loan the first price. So typically what happened at right from, let's say, from age of 25 to 40, you actually land up in buying only properties. After 40, you realize that you don't have that much saving. That's the time the panic starts. You move towards equity market, and the mistake which happened because you have not done the systematic investment plan or you never allocated. The people who will land up in coming at the peak of the equity market cycle. Okay, then they will crib and criticize कि it's very difficult to make money because you were not early investor. When at the young age, when you have large risk appetite, you didn't deploy money in the market, and that's a mistake which I also said that, like, for various reason we have invested in too many houses. Okay, so it's all about uh, I will not say it's a mistake, because they also asset class have also grown, and particularly in Bombay, asset class and grown in everywhere, but not up to that extent what equity market could have given the returns if I could have deployed the same money. Okay,
Right.
and I'm not talking about that you should not do it, but it's about balancing approach. So I will say that you should have 25% portfolio in real estate, 25% should be your strategic investment, which is your equity from longer term perspective. Then 25% your debt instrument and 25% can be your liquid money. So if you can do it, again, this is also depending on what is your horizon and what is your financial background. The financial background is very important. Somebody says, I already have a house, my parents will give this house, ultimately come to know, then that person does not have to invest in real estate. Okay, it's not about getting that perspective that I own it. If you are clear this is family property and you will get it, okay, then you should deploy your money in the equities market early stages, not on the debt side also. And this is a mistake I have seen people making, and even the younger population, everybody is skewed towards house. Because first thing, chhat honi chahiye apni. This is the mindset we have grown. I've seen the exposure, the gold has moved up sharply, the exposure or the inclination to buy gold has actually reduced as compared to what we have seen in the past. Okay, and but towards real estate, that passion has not changed at all. Okay, I think if you can change that mindset, I think it will look good for every investor.
And Sandeep, what's your retirement corpus target, if you have it?
To be very candid with you, I don't want to retire. So there is no question of retire corpus. My liquid asset is good enough to take care of any contingency, and plus being in my office take care of my insurance quite well.
Right.
So I don't need to really plan for retirement plan. Financially, I'm quite well off, so okay, basic needs are fulfilled.
Right.
And what we do is more from a passion rather than more from earning perspective, is more from a passion. I always say, for us, business is byproduct.
And any goals for your families that you are thinking about or need to plan, or in fact, any passion goals also that you may have?
I think, see, as a family, we are achieved most of the financial goals which a lot of people try to look at. My daughter is going her own graduation on the medicine side, So that is the only expenditure technically.
Right.
Then after the kids, they will decide their own future. Okay. Where I will say that I will spend my money. It's not about earning anymore. It's the question of that because you have life is limited. Where you will spend your money is obviously traveling the world. Something where I will plan rather than saying what is the saving I have to do. I will write. I have to plan my expenditure.
What are your plans? Are you planning to travel any interesting places?
No, I do travel because of office related things and it's a technique. If I really look at quant is a very startup mindset thing, so it's a startup company. So you understand it's an asset light model which we build. So we and a couple of my colleagues, we do travel quite often. We call it typically Bharat Bhraman hamara hota hai because we are now a retail centric organization and distributor wants to see you, distributor wants to meet you. It's a at least on multiple occasion they want to interact with you from a market point of view, comfort point of view. They do because ultimately you're dealing with public money. Okay, a trust factor is required. So when they see you or can it's sometimes if you have never met, it becomes very challenging. Sometimes we have seen a lot of people say कि sir आप लोग आते नहीं हो, So I think our objective is to cover all smaller cities. So Bharat Brahman is next 2 years is something which I'm looking at as an organization. We are looking at doing investor education forums or various distributor meets or even certain associations. So we would like to walk this part about educating people about dynamic style of money management.
Sure.
Okay.
Sure. And your contingency fund, you said there is a liquid fund investment that you will have, which would cover how many months or years of your like living expenses, you know, just for benefit. Maybe our listeners can understand why a contingency fund may.
I think contingency fund is not from living perspective alone. It's about any contingency,
Right.
which could be obviously on the health perspective, since we have a large insurance also up to that extent is covered. But it's all about psychological thing. When you talk about contingency, at least when you say certain portion you have, it gives you just psychological comfort that you have liquid assets. See, a lot many people in India, everybody has wealth. And a lot of people have illiquid assets. A lot of people have very large property. Even go to villages, they have acres and acres of land. So it's not like they are poor people. The filthy rich people, when you look at their net worth, the challenges they face is about liquid assets. When they need
Rich cash poor.
yes, when they need the cash and the difficult times, let's say COVID hit us. Okay, who will buy your property? Okay, you can't even sell that. Okay, so liquidity is very important. It gives me just psychological comfort, and for me, debt and I'm talking about putting money in the debt instrument, then it's a liquid fund. Duration also has a risk, okay? And there also have illiquidity issues also. So we have enough to manage those contingency. It's not about how many months. I said I have my financial goals are fulfilled or needs are fulfilled. It's all about the passion which we are working.
No. And health cover is also taken care by us, right? Sure. Great. And Sandeep, this I need to ask you. What keeps you fit and going? What drives you? And also, what are your other passions? Of course, work is your passion that we all can see. Data is your passion. But besides that, what are your other passions? Something that really, you like besides work?
See, to be very candid with you, because passion actually drives, energy levels, is clearly linked with the passion. If you like something, you will take time out of it. Okay, we all have excuse, otherwise उस time नहीं मिलता है ये करने के लिए, correct? Because your passion is not there, your interests are not aligned. For apart from analytics, I like to read, and now with the age and with the YouTube coming into picture, I like to listen a lot of things. Even I'm getting ready, I like to the YouTube is on some whether it's the latest news, some analytic mindset, or even music. I am a great fan of music.
You like
traditional
do your
music.
podcast while you're walking or
Yeah, we sometimes we do that, But what happens off late, it is becoming into people are listening the management calls, earning calls also while walking. So it's a good trend. Okay. So it's music is something which I say, travel is something which I like, it re-energizes me, you get a fresh air, fresh perspective, okay?
Right.
Not meeting the same people, going out and understanding the new culture, new society, it gives you a very different perspective. It actually expands your thinking ability.
Thank you, Sandeep, for joining us today and sharing all those insights. I'm sure these insights will be helpful for our listeners and our viewers who have joined us today and are planning their own investment journey.
Yeah, thanks a lot for coming here.
Thank you, viewers, for joining us today. That was all the time we had for today's episode. For more such interesting content, keep watching Mint.